Hello everyone, Alex Kim here. There is a structural failure scenario in the silver market that most participants are not modeling, not because it's unlikely, but because its consequences are uncomfortable. If it materializes, price will be the least important variable. Today I want to walk you through the structural issue in precious metals that centers on the concept of delivery failure and what that would mean for the entire financial architecture. When we discuss monetary assets like gold and silver, we're talking about assets that compete directly with currencies that central banks can print at will, and the belief among certain analysts is that silver will be the first point of stress in this system. If a major institution experiences a failure to deliver physical metal, the implications extend far beyond the metals markets because these banks don't operate in isolation. They trade everything. Their balance sheets touch equities, bonds, currencies, derivatives, and commodities. A failure in one corner can propagate rapidly. This is why the scenario matters more than most realize. It's not about whether silver reaches a certain price level. It's about whether the institutions facilitating silver delivery can fulfill their obligations when stress intensifies. Now consider the context. In 2008, when systemic stress emerged, the US Federal Reserve opened swap lines to support institutions like the Swiss National Bank, effectively bailing out the global banking system. But what happens if the next crisis unfolds without that kind of immediate intervention? What happens if central banks choose not to rescue institutions facing delivery failures? In that scenario, you're looking at a potential breakdown in confidence that could force real price discovery in metals. And when analysts discuss potential silver prices in that environment, they're no longer talking about modest moves. The range being discussed runs from current levels all the way to $700 an ounce. Now, some might dismiss $200 as extreme, but given the structural vulnerabilities and the tightening physical inventories, it's not as far-fetched as it might sound. This isn't speculation. This is positioning. The conversation around gold's potential role as a reserve standard replacement for the US dollar is gaining traction, and it's worth examining what that implies. The argument is that countries are increasingly using their own central bank digital currencies to settle trade outside of SWIFT networks, and instead of holding US treasuries as reserves, they're holding gold. There's a report from an emerging markets bond team that attempts to value gold by matching central bank money liabilities to gold reserves, and the numbers are striking. Using M0, which represents the base level of money supply, the calculation suggests a gold price of $39,000 per ounce when weighted by daily foreign exchange turnover. If you use M2, which includes broader money supply, the implied price rises to $184,000 per ounce. Now, these aren't predictions of where gold will trade tomorrow. These are theoretical valuations that illustrate what happens if gold becomes the primary settlement vehicle for global reserves. The point being made is that gold is being reintegrated as the preferred reserve vehicle, particularly in the global south, and this process is already underway. There's also discussion around the possibility of pegging the back end of the US bond market to gold, and if that were to occur, the mechanics become fascinating. If the US sells a $20 million bond today that must be settled in gold in 30 years, and gold is trading at $5,000 per ounce now, but reaches $184,000 per ounce by the time of settlement, the number of ounces required to fulfill that obligation drops dramatically. That would effectively devalue the dollar massively while reducing the physical gold burden on the issuer. The implication is that we're moving away from the dollar as the de facto global reserve currency, and this isn't a sudden shift. It's been happening gradually since 1971 when the link to gold was severed. The argument is that the dollar has been losing value ever since, and the fiscal irresponsibility of recent decades has eroded trust to the point where holding dollars carries significant risk. Watch the flow, not the headlines. When you think about why people buy gold, most assume it's about inflation protection, and that's partially true. But the more important function of gold is protection against default. That's what the market is currently pricing in. There are serious fiscal problems in Japan. There are serious fiscal problems globally. You're seeing gold rising while bond markets around the world decline and currencies weaken. In that environment, gold and silver become the natural destinations for capital-seeking safety. Silver has a monetary history that distinguishes it from other precious metals like palladium and platinum. It has functioned as money for centuries, and that history matters when trust in fiat systems erodes. The challenge for anyone holding gold or silver and considering taking profits is simple. Where do you put the proceeds? There are no credible currencies anywhere on the planet to hold capital safely. If you sell gold or silver, you're converting back into a depreciating asset. The public narrative lags the positioning. So the question becomes, what other assets make sense in this environment? If you're positioned in a major city, that could become problematic when systemic stress intensifies. The suggestion is that those with significant holdings in gold and silver should consider relocating to rural areas where lower infrastructure dependencies exist, and security risks are more manageable. It's not just about financial positioning. It's about physical positioning as well. If you find this breakdown useful, consider subscribing to the channel so you don't miss how these signals evolve. Now let's revisit the fundamental nature of gold and silver because this is where the clarity comes from. An ounce of gold is an ounce of gold. It was the same 100 years ago. It will be the same 100 years from now. Gold doesn't change. It doesn't go up or down in real terms. What changes are the currencies it's priced in. People often ask whether they should sell after such substantial gains in gold and especially silver. The answer starts with a question. If you sell, where do you put the money? What currency do you hold it in? Where in the world is there a credible currency that you can confidently use to store capital? The problem is there is no credible currency in the world today. What we're witnessing is currencies collapsing. The fiat system is failing. The experiment that began at Bretton Woods in 1944 and accelerated in 1971, when the dollar was unpegged from gold, is now showing signs of terminal stress. People are recognizing that failure and moving capital out of currencies and into real money, which is gold and silver. If silver is part of your portfolio, write allocated in the comments. Central banks are doing the same thing. Why are central banks buying gold? The answer is straightforward. They don't trust the large balances they hold in dollars. They're concerned about a scenario where those dollar holdings evaporate in value, leaving a gigantic void in their reserves. So they're buying gold to plug those holes, to offset the risks embedded in fiat currency exposure. Institutions don't chase price. They manage exposure. Consider Russia as a concrete example. Russia's admitted gold reserves have risen by $260 billion since the United States froze $300 billion of their assets. Now there's reason to believe Russia holds even more gold than they publicly disclose, but the admitted figure alone illustrates the point. A central bank holding gold can offset losses in fiat currencies or treasury credits. That's a real-world demonstration of how gold functions as a reserve asset in a world where geopolitical risk and currency risk are rising simultaneously. This is not a retail story. The movement we're observing in gold and silver isn't driven by individual investors chasing momentum. It's driven by central banks, sovereign wealth funds, and institutions recognizing that the architecture of the global monetary system is under stress. The Bretton Woods framework and the subsequent fiat experiment that followed the 1971 decoupling have created vulnerabilities that are now becoming visible. The question investors face is not whether gold and silver will continue rising in nominal terms. The question is whether there will be any stable currency to measure that rise against. If currencies continue to devalue and trust continues to erode, then gold and silver aren't going up. Everything else is going down. That's the reframing that's necessary to understand what's happening. When you hold gold and silver, you're not speculating on price appreciation. You're holding insurance against the collapse of the monetary system itself. That insurance has a cost, but in an environment where systemic risk is rising, the cost of not holding it could be catastrophic. Now let's talk about the potential for delivery failure. because this is where the system could break in a way that forces immediate repricing. And this connects directly to the uncomfortable scenario I mentioned at the beginning. Silver, in particular, is vulnerable because the physical market is smaller and tighter than gold. If a major bank fails to deliver silver on a contract, that's not just a contractual issue, it's a confidence issue. These institutions are interconnected. They provide liquidity across multiple markets. A failure in one area raises questions about their ability to meet obligations in other areas. That's when contagion risk becomes real, and that's why price becomes the least important variable. What matters is whether the system can function at all. In 2008, central banks acted quickly to prevent cascading failures. Swap lines were opened. Liquidity was provided. The system was stabilized, at least temporarily. But there's no guarantee that response will be repeated. If central banks decide not to intervene, or if the scale of the problem exceeds their capacity to intervene, then you're looking at a scenario where markets have to clear without official support. In that scenario, prices move to wherever they need to move to balance supply and demand. And that could mean prices that feel extreme by today's standards. Silver doesn't move first. Stress does. The analysts discussing $700 silver aren't making idle predictions. They're extrapolating what happens when physical tightness meets loss of confidence in the institutions that facilitate delivery. $200 per ounce no longer seems absurd when you consider the leverage in the paper markets relative to available physical inventory. If the paper market breaks, if confidence in contract settlement erodes, then price discovery shifts entirely to the physical market. And the physical market is much smaller and much less liquid. That's where explosive moves occur. The scenario being outlined isn't dependent on a single catalyst. It's dependent on a convergence of factors. Fiscal stress in major economies, central banks losing control of bond markets, currency devaluation accelerating, physical metal inventories tightening, institutional failures in delivery. Any one of those factors can create volatility. All of them together create systemic risk. And when systemic risk materializes, gold and silver stop behaving like commodities and start behaving like the ultimate safe haven assets they've always been. The challenge for investors is psychological. It's difficult to hold an asset that has already appreciated substantially and resist the urge to take profits. But taking profits implies you have somewhere safe to deploy the proceeds. In the current environment, that destination doesn't exist. Currencies are depreciating. Bonds are losing value as yields rise. Equities are vulnerable to repricing if the macro environment deteriorates. Real estate in urban centers carries risks that go beyond valuation. So what's left? The answer is tangible assets with no counterparty risk. Gold and silver fit that description. They're portable, divisible, globally recognized, and have functioned as money for millennia. That's why central banks hold them. That's why sovereign wealth funds are accumulating them. And that's why individuals who understand the structural risks in the current system are positioning accordingly. The move toward gold as a global reserve standard isn't hypothetical. It's happening in real time. Countries are settling trade in their own currencies backed by gold rather than using dollars backed by debt. The shift is gradual, but it's directional and it's accelerating. The theoretical valuations of $39,000 or $184,000 per ounce aren't price targets. They're illustrations of what gold's value could be if it were fully backing the global money supply. Even a partial move in that direction would require substantial repricing. And if gold reprices significantly, silver will follow, likely with greater percentage gains due to its smaller market size and dual role as both a monetary and industrial metal. The other dimension worth considering is physical security and location. If systemic stress intensifies to the point where currency failures and delivery failures become widespread, urban centers could become challenging environments. Infrastructure dependencies, supply chain vulnerabilities, and population density all create risks that are harder to manage in cities. The recommendation is that those holding significant metal positions consider whether their physical location aligns with their risk assessment. If you believe the system is vulnerable, positioning yourself in a rural area with lower dependencies and greater self-sufficiency makes strategic sense. This isn't about fear. It's about matching your physical positioning to your financial positioning. If you're holding hard assets because you don't trust the system, then it follows that you should position yourself in an environment where system failures have less immediate impact. Now let's return to the core question. Where does this leave us? The monetary experiment that began in 1944 and accelerated in 1971 is showing signs of failure. Trust in fiat currencies is eroding. Central banks are accumulating gold. Countries are moving away from dollar-based settlement. Physical metal inventories are tightening. Institutional delivery risks are rising, and there are no credible alternatives to gold and silver as stores of value in this environment. The analysts discussing extreme prices for silver aren't engaging in hype. They're assessing what happens when structural vulnerabilities meet market reality. If delivery failures occur, if central banks don't intervene, if confidence breaks, then prices will move to levels that clear the market, and those levels could be dramatically higher than where we are today. The timeline is uncertain. The direction is not. The system is under stress. The stress is building. And gold and silver are the assets positioned to benefit when that stress becomes uncontainable. For investors, the framework is simple. You're not holding gold and silver to speculate on short-term price movements. You're holding them as insurance against systemic failure. You're holding them because there are no credible currencies to store wealth. You're holding them because central banks are doing the same thing. And you're holding them because history has repeatedly demonstrated that when fiat systems fail, precious metals reassert their role as real money. The question isn't whether to hold. The question is whether you're positioned correctly for what comes next, both financially and physically. If you want to stay focused on what actually drives the silver market, subscribe and leave a comment with what you're watching next.